Welcome to our first quarterly economic update web presentation. We plan to bring this to you both in print and in this format going forward. I hope you find this helpful. Matthew Henry, an English author who lived in the 1600s, is credited with saying, "After a storm comes a calm." Perhaps that best describes the first 3 months of 2016. Investors experienced an unusually volatile first quarter, and as of March 31st, the U.S. stock market ended the quarter higher than it started the year. Following its worst start to a year since 2009 and a fall of more than 10%, equity markets enjoyed an equally swift recovery of over 10% that more than canceled each other out. By the end of the quarter, the Dow Jones Industrial Average was up 1.49% for the year. The S&P 500 index was up 0.77%, or about where it started, and the NASDAQ fell 2.75% for the first quarter of 2016. The quarter produced a V-shaped chart that was filled with volatility. In short, the world had a scare about a U.S. recession and deflation and then recovered from it, all in less than 3 months. As a result, the Dow Jones Industrial Average saw its biggest quarterly comeback since 1933. Fidelity Investments stressed to investors that although the U.S. market seemed to have ended the quarter in a decent place, that we cannot therefore ignore the dramatic events of the past 11 weeks, even if they have left the world's biggest stock market exactly where it started. Since investors should not ignore the dramatic events of the past quarter, what has changed since the year started? Oil seemed to have found a bottom and prices have risen, with crude up more than 50% from its January low, while the dollar has weakened. Oil and the dollar tend to have an inverse relationship, with the dollar rising when oil falls and vice versa. Oil remains more than 60% down and the dollar more than 20% up from their levels of summer 2014. These factors relieve some of the fears investors had over bankruptcies in the U.S. energy sector. While oil traders may be disappointed with lower prices, this would seem to be good news for the U.S. economy. For years, politicians and consumers have griped about the high price of oil and how it hits consumers in their pocketbooks. Now that gasoline prices have fallen below $2 a gallon in much of the country, consumers will have more money to spend and stimulate the rest of the economy. Although low energy prices are still better than high energy prices, a continued decline should worry investors about the possibility of smaller oil companies going bankrupt and the harm that it could do to the market. The table on the left-hand side shows the growth in supply and demand for petroleum over the past few years, which highlights that while demand has not increased much globally, supply has. The increase in supply has mainly come from the U.S. due to the shale oil revolution, shown by the steady increase in inventories on the bottom left chart, while the number of active rigs producing the supply has fallen with prices. This increase in supply is one of the drivers of the recent downturn in oil prices, which can be seen on the right side of the page. Energy investors are still grappling with the critical question: how long will it take for the oil industry to work through the current period of oversupply and rebalance itself? U.S. output is likely to decline this year due to heavily reduced capital spending. Consequently, while global demand is expected to grow by around 1.2 million barrels per day in 2016, global supply is expected to remain fairly flat and won't grow in 2017 either if oil prices average less than $50 per barrel this year as expected. However, the magnitude of the current oversupply is such that global stockpiles will continue growing through mid-2017 in all but the most optimistic scenarios. Therefore, Morningstar Stock Investor expects WTI prices to hold steady in the $35 to $45 per barrel range for the next 12 to 18 months, with the caveat that the scaling back of economic forecasts in consumer countries, especially China, is a key risk that could trigger further weakness. Beyond that, we anticipate a gradual rebound to the mid-cycle levels of $64 to $70 per barrel, which are consistent with long-run marginal costs. Corporate profits are important for investors to watch. Fidelity suggests that currently corporate profits have been disappointing and many companies have guided us to expect worse. Also, corporate share buybacks were high this quarter, at $95 billion in February. According to TrimTabs, the money U.S. companies spent on their own stock was the third highest in a month on record. The U.S. stock market is trading at an earnings multiple of approximately 18, which is not considered historically cheap. Therefore, investors need to keep a watchful eye on earnings. These charts demonstrate the historical relationship between forward PE levels and subsequent 1- and 5-year returns. The purpose is to show that while valuation measures such as the forward PE don't necessarily have predictive power in terms of returns over a short period of time, 1 year, There is much tighter correlation when using longer periods such as 5 years. Again, this quarter, interest rates and the Fed watching continued. Investors were carefully watching federal funds rate in anticipation of a rate increase. In December of 2015, the Fed raised interest rates for the first time in 7 years and suggested that this was the beginning of anticipated rate increases. In December, Stanley Fischer, the central bank's vice chairman, said that for 2016, 4 interest rate increases were in the ballpark. That sentiment changed on Tuesday, March 29th, when Federal Reserve Chair Janet Yellen said in a speech that various headwinds existed, which made it difficult to justify aggressively increasing lending rates. While global growth has become an issue, rising real interest rates have also weighed on both economic activity and financial market euphoria. Whether you agree with it or not, this seems to be the policy direction of the Federal Reserve. Even at the Fed, however, many aren't in agreement. Prior to this, several Fed members expressed a more hawkish view, suggesting that interest rates may indeed rise faster. In the wake of Yellen's statements, markets cheered. The prospect of continued low rates is usually seen as good for stocks, and that is playing out. Longer term, though, Yellen's stance raises deeper questions. As for some overseas central banks, they are unclear in where rates can go, at least when it comes to exchange rates. Both the Bank of Japan and the European Central Bank cut rates further into negative territory this year, and both saw their currencies strengthen. This is largely because markets perceive, perhaps correctly, that the banks can take rates no lower. This will depend on the Fed's interpretation of primary indicators. At some point, improvements in employment and increases in inflation could encourage the Fed to aggressively raise rates. As of March, the markets seem to be suggesting that a low-for-longer path remains the most likely course for rates. The Federal Open Markets Committee in March predicted 2 increases in the federal funds target rate from the current 0.25% to a 0.5% range. The federal funds rate is an important benchmark in financial markets. It is the interest rate that the borrowing banks pay to the lending banks to borrow funds. It is negotiated between the two banks, and the weighted average of this rate across all such transactions is the federal funds effective rate. While the federal funds rate is only directly applicable to banks that lend to one another, it has become a benchmark for consumer and business loan rates. Business executives and investors keep a close eye on the federal funds rate and the FOMC's position on the economy to help them adapt their business plans accordingly. The prime rate, for example, is established by banks and is offered to their best customers. It's used to determine interest rates for a variety of loans, including credit cards, car loans, small business loans, and home equity lines of credit. Interest rates are still low by historical standards, and as financial professionals, we will watch them. Should you have any concerns about your holdings, we'd be glad to recheck your personal situation during your next review or at any other time. So what should an investor do? Investors are concerned about the market. After all, the market is up once again. Historically, prior to 2016, March shows up as the 4th best month for stocks after December, November, and April. According to Bespoke Investors and MarketWatch, over the past 65 years, the S&P 500 has risen 42 times in March and fallen 24 times, with average returns of 1.06%. The positive returns of March 2016 will increase that number. While the mood is cautious, Bespoke Investment Group's numbers show that April is not the cruelest month for investors. History shows that a positive March is typically followed up with a slight gain in April. However, some believe that this time it could be different. So what's in store for the second quarter? Number one, we are living in a low-return world. Quantitative easing and negative interest rate policies have inflated financial markets. Many assets have had a great run since the financial crisis. This means future returns are likely to be more muted. We have been borrowing from the future. 2, monetary policy divergence. A key driver of the U.S. dollar's gains looks to be slowing. The Eurozone and Japan are reaching the limits of negative interest rates, and we see future easing coming through QE. The Fed has signaled a slower pace of rate increases, and this bodes well for the markets. 3, BlackRock, the world's largest investment manager, expects more volatility as the Federal Reserve normalizes policy. The business and credit cycles mature and risks come to the fore. We see sharp momentum reversals as many investors have piled into smaller correlated trades. This means diversification and security selection are key. Our advice is not one size fits all. We will always consider your feelings about risk and the markets and review your unique financial situation when making recommendations. You may have heard that the Department of Labor has just issued a new regulation that requires financial advisors and brokers to act in the best interest of their clients. I am sure you are surprised to hear that this was not the case, yet it is true. Momartz Mahaney Financial Services, Inc. has been a CFP firm since 1997. CFPs have always been bound by a code of ethics that requires us to act in your best interest. This law may be new for most people in our industry, but it has been our standard practice for nearly 20 years. Thank you for your continued trust in us.